Good morning, everybody. Welcome to Level and Partners spring reaction to the spring statement last week. My name is James Emery. I'm a director at Level, and we provide very specialist probate funding to both beneficiaries who may require early access to funds through our inheritance advance, or to executors, both lay and professional, where the estate is cash or liquid and perhaps there's inheritance tax to pay or other executor expenses. So thank you for joining us this morning. Last spring statement didn't specifically introduce any major changes to inheritance tax, but I think it reinforced the government's commitment to cracking down on tax avoidance, especially in areas where reliefs have been used to shield significant wealth. IHT reforms announced in the autumn statement in 2024, they're scheduled to begin rolling out from April 25 this month to 2030, including a shift to residency-based IHT, restrictions on agricultural property relief and business property relief, and the inclusion of pensions in estates. We'll discuss this during this session. During the session, if you have any questions, if you could perhaps pop those in the chat, and hopefully we'll have time to visit some of these at the end. I'm going to hand over to both Harriet Betteridge and Daniel Cottam now to introduce themselves. Starting with Harriet.
Thanks, James. My name's Harriet, as James has alluded to. I'm a solicitor at Charles Russell Speechlys. We are an international full-service law firm, and I work in the private client team. So my focus is on succession, so planning for individuals about their succession, how they're going to pass their assets on and structure those in a tax-efficient way, and then dealing with their estates after they've died. So that's me in a nutshell. Daniel?
Morning, everyone. My name's Daniel Cottam. I am a founder and head of financial planning at Aetas. Essentially, at Aetas, we provide three core services, which are sort of wealth management, stroke financial planning, business services, and project funding. So essentially, we are aiming to be a sort of comprehensive one-stop shop. And we bring together a network of advisors from different fields that can support our clients with varying needs throughout their lifetime, with a focus on legacy and inheritance tax planning.
Thank you very much, both. So we will move on with the various discussion points. Harriet, I wonder if you could provide a summary of the new residency-based IHT changes.
Yeah, absolutely. This is an enormous topic, so I'm not going to give you all of the detail because we would be here for about 3 days probably. But broadly speaking, for inheritance tax purposes, which is what we're kind of focusing on today, there's going to be a shift which will take effect from Sunday, which is the start of the new tax year. And we are moving from the concept of domicile being the determining factor as to the extent to which inheritance tax is charged on your worldwide assets, to the concept of long-term residency. So as things stand today, if you are domiciled within the UK, then your worldwide estate is subject to UK inheritance tax. But if you are a non-dom, then only your UK assets are subject to inheritance tax. And there are some deeming rules that mean if you've been here for 15 out of the last 20 tax years, you are deemed to be domiciled here, so your worldwide assets are taxed. From the 6th of April this year, that is shifting. So the idea of domicile as the kind of determining factor is disappearing and being replaced with long-term residency. So then everything will turn on if you are a UK resident or not. And it will all be to do with the number of years that you have been here. The key really, and so the kind of major shift is that it's going to bring more people more quickly into the full UK tax net on their worldwide assets, because you will only have to have been here for 10 years before you are in the UK tax net, and all of your worldwide assets are subject to inheritance tax. So there's a shift from 15 out of 20 years to 10 out of 20. So that's quite significant. There's also quite a lot of changes in the rules to do with income tax and capital gains tax, but I think that that's not really a topic for today. So that's a very high level overview of where we are.
Thank you, Harriet. Daniel, do you have anything to add to that?
I mean, to be honest, the vast majority of our clients are both UK domiciled and resident. So it doesn't affect us so much. But, all I can really sort of comment on is what I've kind of seen and heard in practice. We partner with lots of accountancy firms helping out their clients. And it's amazing, no matter the size of the firm, whether they're sort of, 1-2 man bands up to sort of much larger accountancy firms, they all are telling me the same thing, which is about an exodus of clients from the UK. And it seems to range from, ultra high net worth business owners who are closing businesses and leaving, and even just kind of, moderately sort of high earners who kind of have the ability to relocate their work life. And I just don't think a lot of people really sort of understand how globally mobile a lot of people and wealthy people are. And so, it's really just comes down to a simple calculation, doesn't it? I mean, for a lot of people, it just is like, am I better off in the UK, or can I be, somewhere else, and get around all of these, all of the changes that have happened? So I think it was quite documented last year, wasn't it? I don't know whether it's entirely true, but it was a sort of a millionaire every 45 minutes is leaving the UK, and you don't have to be an economist to realise that that's not good news for the UK economy as a whole.
Thank you, Daniel. That's insightful. So Daniel, staying with you on the impact of inheritance tax on pensions and rethinking retirement plans. From April 27, unused pension pots will count as part of the estate for inheritance tax, closing a popular estate planning strategy which kept these outside of the IHT net. How are you advising your clients on this? Should someone nearing retirement rethink the order in which they use their assets, drawing down pensions versus ISAs, for example, or consider alternative strategies?
Yeah, well, I mean, for me as a financial planner, this has definitely been the biggest talking point really with clients. And also when you couple that with the freeze on inheritance tax thresholds, which is until 2030. So just as a quick recap, I'm sure most people know this, but everybody has a nil rate band of £325,000 that they can hand down to the next generations free of inheritance tax. And then they have a further 175,000, which is the residential nil rate band. So as long as you're passing a property down to a direct descendant, whether that's children or grandchildren. So, everybody has 500,000. Let's just take the norm, I suppose, a couple. So as a couple, you could pass down £1 million free of inheritance tax to your beneficiaries. It doesn't take that much now. You only have to be a property owner really in London and large parts of the southeast. I know that's a bit of a generalization, but I live in a normal terrace street in London. My next door neighbour, for example, inherited the house from her parents. She's been here since 1982. She certainly would not be sort of considering herself to be wealthy, and she won't be able to do the same in terms of pass the house down to the next generation. So those changes are very wide reaching really. So yeah, it has changed the way that we talk to our clients. I suppose it's really highlighted the need for advice and continued advice, because as you just said, James, people have been planning potentially for decades using the pension as a way of mitigating some of the IHT liability, and that's no longer going to be the case. So you have to look at all sorts of other planning really, and it highlights, I suppose, the need to start as early as possible. I mean, these are theories because we all know that the practice is sometimes a lot harder because life gets in the way, but the earlier that you can start planning for inheritance tax, the better. And it could be anything, making sure that you're utilizing all the annual exemptions, making gifts early as possible to mitigate the sort of 7-year rule. We can look at gifting out of surplus income. So as long as you are making regular gifts and it doesn't impact your lifestyle, you can do that. There are ways that you might want to give at least 10% of your estate to charity. That brings down the inheritance tax from 40% to 36%. And then, as you said, we are now talking to clients about different ways in which you might want to liquidate your assets, rather than leaving your pensions untouched, which clients have been doing. We're looking at sort of maybe utilizing the pensions now. In all honesty, it's just utilizing pensions for what they were originally designed for. They were designed to create an income for you in retirement. So having to do that and maybe look at other ways in which you could move your ISAs into business relief qualifying assets. I know we're going to talk about that in a bit. But the other thing we are seeing a lot more of is a sort of need and sort of looking at whole of life assurance policies. So essentially, everybody's probably very aware of what life insurance is. Most people have it on a term, so either through work as a death in service or to cover your mortgage. And essentially, you pay your premiums, and the vast majority of people never draw down on that policy. Whole of life is as it sounds. So you cover your life, and as long as you continue paying the premiums, it will pay out on death. The problem is it hasn't really been used a lot over the past because they are more expensive. But we are seeing more and more clients now who are viewing this as a good way of mitigating their inheritance tax. So yeah, it's changed, but unfortunately it's caused a lot of uncertainty, and there still is a lot of uncertainty out there. I mean, we were told what's happening with the autumn budget, but there are still details to be fleshed out, and we're still waiting for that.
Thanks, Daniel. You covered some of the steps that can be taken to reduce the future IHT bill as well. Gift allowances, gifting wealth to children sooner, or talked about life insurance. Thank you for that. Harriet, I'm just wondering if you have any thoughts on pension providers and those tactics that Daniel just alluded to.
Yeah, thank you. I mean, Daniel makes some very good points about, thinking about wider planning, given that pensions are going to be brought into the taxable estate. I think one of the kind of key things for clients to be thinking about is not just the kind of number and the overall tax bill, but actually how it's going to be paid. And as Daniel alluded to, that used to be, the pension pot used to be a really good way of funding that, and you could get hold of that cash quite quickly. So it was available, so it could be used to pay the IHT bill, which would allow the administration of your estate to continue and your executors to get a grant of probate. But that's all going to become a lot more difficult because we wait to see the details of the consultation and how the government thinks things are going to work and the steps they're going to put in. But you do worry about what pension providers will want in order to release funds. And I think, they are going to want to make sure that they are meeting their reporting obligations and their obligations to pay over, the amount of tax that's payable on the pension to the revenue, because it looks like they're going to be under an obligation to do that, and query whether or not they will release other funds to pay tax early. So it may be a case of, as Daniel says, thinking about life insurance and other ways of funding that cash. And, that may mean, using services like yours, James, from Level to fund the tax. I think we're going to have to become a bit more creative with all of this.
Thanks, Harriet. So moving on to agricultural business property relief changes. Harriet, staying with you if that's okay. Significant reforms to APR and BPR confirmed in the autumn budget. From 6th of April 2026, the first million of a farm or business's value still gets that 100% IHT relief, but anything above that only gets 50% relief. How do you anticipate this will impact family farm businesses who expect to pass on assets tax-free in the past? Are there legal strategies, restructuring ownership, trusts, lifetime transfers that these clients should now consider?
Thanks, James. Yeah, I mean, it actually follows quite neatly on from that point about pensions and the funding point, because suddenly for agricultural and business assets, if they're worth over $1 million combined, then there's going to be a tax bill. And so that question of how that is going to be paid arises where it hasn't done before. Previously those sorts of assets were held by clients and they kept them until death. They had control of them, they had the ability to make use of them, to benefit from them, and then they could pass them on tax-free on their deaths. But now that's not the case, so we're looking at planning in a different environment, really. And so it's raising questions that some clients haven't ever really thought about before, about should I be passing on my business or my farm during my lifetime to my children? At what point is it appropriate to do that? And many of these questions, although they're kind of tax driven, there are real control and protection issues that are coming up, because whilst from a tax point of view it may be sensible to try and pass on your business, pass on your shares in your company, or pass on your farmland during your lifetime, actually, does that work? Are your children at an age and stage in life that it's suitable for them to receive those assets? Have they got other issues going on in terms of their own personal lives, their marital situations, their health? Are they going to be able to start farming? All of those kinds of things. There's a really big picture to consider, and the tax is one thing, but you can't kind of look at that in isolation. So I think it's really a bit of a kind of a change of perspective for a lot of clients in thinking about these things and grappling with questions that they have never thought about before. I mean, I think overall these changes to agricultural and business property relief and the charges that are going to arise mean that clients will start thinking about passing assets on earlier, but that's not always the right answer for everybody. So each person needs to be you need to look at each person individually, because they will need a bespoke solution.
Yeah, thank you, Harriet. And I think that segues nicely across to Daniel. So Daniel, we're talking about clients who are now facing the reality that anything over £1 million in value won't be sheltered by these reliefs. As a financial planner, how do you help your clients like these prepare? Does it come down to ensuring liquidity, or other investment and succession planning moves that can soften the blow? For example, would you suggest diversifying assets, or maybe bringing the next generation into the business ownership sooner to spread the value?
Well, the simple answer to that is all of the above, really. I mean, I think Harriet sort of said it brilliantly. It is on a client by client basis. It does show that the complexity of planning now, because there is still so much uncertainty. Especially if you look at the sort of agricultural side, it's really doesn't take very much, a very big farm, to be worth more than £1 million. And it's been well documented in the media, and with all the sort of farming protests, farms are asset rich, but generally as a whole they're quite cash poor. And so, yes, in theory, we could say, well, okay, look, what we need to do is we need to ensure more liquidity. We need to diversify your assets. We need to do planning, earlier. We need to do all of these things. But in reality, life doesn't quite work like that. And it's not as simple. Even if we go back to, whole of life policies, which are a really effective tool, but they are expensive, potentially more expensive a way of doing things, and so it's about affordability. And also because of the speed of the changes, there are going to be an awful lot of business owners and farmers out there. As we know, farmers especially, they don't essentially ever retire. So, a lot of these farmers are, you'll find farmers in their 70s, 80s and beyond who are still in control of those farms. And yes, they have the next generation working with them. But, they don't now have the time to do any planning. And so there's going to be a lot of farmers that are caught up in the change of legislation without any real ability to plan. Again, I think it just shows the sort of the complexity that we now face, the difficulties that we have as financial planners in terms of being able to make a realistic plan for people to fully get round inheritance tax. And it's it just shows it's not, you know, the new legislation isn't just about, you know, ensuring that the wealthy pay their share. It actually, what it's doing is it's making sure that an awful lot of people are going to be caught up with this problem. So, you know, there are bits that we can do. I think the reality now is it's very hard to completely mitigate inheritance tax. But you know, again, I think we're going to see, as things bear out over the coming years, exactly what the effect is. Personally, I think there might be a sort of bit of a damage to the way that we produce food in this country from the agricultural side.
I would just add, just thinking about the planning, and you know, to Daniel's point about, you know, often farmers particularly are, you know, quite a advanced age that they can't really do any planning. One of the key things that the government seems to be pressing and not changing its mind on is that this £1 million allowance won't be transferable between spouses. So different from how the nil rate band works at the moment, which is transferable. And so the key to that is, even if clients can't do any kind of lifetime planning in terms of their gifts, is making sure that their wills are set up so that they're making use of the allowance when the first the first of a married couple dies, so that, you know, at least if you've got a couple, you're getting £2 million worth of the allowances rather than wasting one of them.
Thank you both. That's great. Well, we're moving very nicely to time, so I've got a couple more questions for Harriet and Daniel, but we should have time for questions at the end. So if anybody has any questions, please pop these in the Q&A section at the top of the screen, and we'll come to that. So Harriet, just looking ahead, it's a bit of an unfair question, and I'm hoping that you've got your crystal ball to hand. You know, while last week's statement contained no new inheritance tax measures, there's a lot of speculation that further tax increases or rule changes could come in the autumn 25 budget. Without asking you to guess government policy, although I think that's what we're doing, what areas of IHT law do you think might be next in line for reform, and how can families prepare for these possible future changes without knowing exactly what's coming?
Oh, thanks, James. I think if I did have a crystal ball, I might not be here. I might be sunning myself on a beach in Barbados. But yeah, I think there's lots of things they could potentially tinker with. Something that has been brought up quite a lot from time to time, and I certainly don't think we should rule it out, is changing the way that the 7-year rule works. So just by way of reminder for people, broadly speaking, if you make a gift and you survive for 7 years, then it's outside of your estate for inheritance tax purposes. There has been a lot of talk about changing that period from 7 years and increasing it perhaps to 10 years or more, or perhaps putting a cap on. So currently you could give away an unlimited amount of money, and as long as you survive for 7 years, that can all be exempt. But there is thought that maybe there should be a kind of cap on that, in the same way that there is in the States, for example. So yeah, I wouldn't be surprised if we see changes like that in the future. In terms of if and when they come in, who knows? I don't have a crystal ball, unfortunately. I think for clients, you know, in light of that and the general, you know, the government's general kind of squeeze and tightening of inheritance tax rules, I think it's really a point for discussion as to whether they should start making gifts sooner rather than later. Key to all of this is obviously affordability, and whether it's appropriate for the client to be doing that. And as you know, we've talked about earlier, it's not always just about the tax, but there are lots of other factors involved. But if clients, you know, are intending to do things like that, it may be a kind of an acceleration of those plans, so that they happen sooner rather than later.
Thank you, Harriet. And then Daniel, lastly to you on the subject of preparing for uncertainty. Already rumours that the government might resort to further tax hikes or tightening of reliefs in the autumn. How do you counsel your clients when facing this uncertainty? How can families make their financial plans flexible enough to weather whatever these IHT changes are potentially forthcoming in the next few years, from now right the way through to 2030?
Well, look, I think the number one thing I say to clients is don't panic. You can't. We don't have a crystal ball. Harriet's just brilliantly said. What might come in, and it does. It just says all it's really pointing to is do some planning earlier on in life, if possible, and that's the big thing, if possible. It's a very dangerous game, I think, as a financial advisor, to start trying to second guess what's going to happen and plan based on that. We can only advise our clients on what the legislation is today. We can have an eye on what we think is going to happen, but we can't really put any plans in based on that. Essentially, every plan that we put in place for clients is designed to be flexible. I mean, we use cash flow planning, which is a very sort of visual way to highlight to clients kind of where they are, what the plans are doing, and what effects those plans are going to have in the future. And yes, we can then play around with that and say, well, okay, if this happens, this is the likely outcome. And, we change the parameters to help clients to be able to see what those effects are. But, essentially, we can only go on what we've got today. And I think we've covered it. We've got to, clients, if they can, have got to try and start to think about these things much earlier than they otherwise would do. But it is incredibly hard to, I'm in my latter 40s, and if I wasn't in financial planning, there's no way I'd be sort of thinking about inheritance tax planning. But you almost have to start saying that, if you're in your 40s, if you're in your 40s, you're most likely to have youngish family, which takes up, let's be honest, for most people, it takes up their capacity to be able to actually make any plans. So then you're sort of going into your 50s and 60s, and the later it gets, the harder it's becoming. I mean, the government are quite clearly taking us in one direction, and so we need to do all we can to make plans. But I think it is just a reality that people are going to have to start to face, that it is quite likely that they will have some inheritance tax to pay on their estate. So we'll see what the next budget brings up. But I don't think anything's going to be made easier or loosened. So we just need to, I suppose, prepare ourselves, but only act on what we know today.
Thank you, Daniel. Thank you, Harriet. There are no questions currently in the chat. So if anybody would like to unmute themselves, if they're able to do that, and ask a question, or if not, type a question in the chat section and the Q&A section, then we'll answer that. We've run unbelievably to time. So whilst we're waiting for that, is there one there? We've got a question from Kira Murphy. Can leaving things in trust in wills help avoid IHT, or will the impact still be the same? I think we'll go to Harriet there.
Shall I take that? Yes. So leaving assets in a trust under your will, so the inheritance tax is kind of looked at the point of your death. So kind of with an eye to what happens under your will, because that will determine whether there are any exemptions and things. So trusts can be helpful because it can be a way to put assets that have relief into a structure so that it doesn't go and make anybody else's estate bigger for inheritance tax purposes, but it won't necessarily kind of reduce the amount of tax payable at the point of someone's death. So it's a bit of they can help, but they're not bulletproof, and they're not always the best way to go forward. They can be very useful for other reasons, though, for protection and control and things like that. So I think often, historically, trusts have been very, very tax efficient, and the landscape there is definitely changing, and they are a lot less tax efficient generally now, or they're not a way to get out of tax where they may historically have been, but there is definitely still a real use for them, but that's much more around keeping control and protecting assets and protecting beneficiaries from themselves and from others, I would say.
No, can I
Harry.
just make one last point, actually, James, just on not so much on trust, but I think it does bring into the fact that, when you're looking at planning, hopefully we've highlighted a number of different strategies that can help. The reality is that when we're advising clients, there is no one magic answer for them. And so essentially it is normally looking at everything that's available to us to help their particular situation and utilizing a number of them. So, it might be that you might use trust for some parts of the estate, then you might use, the gifting, you might use the whole of life, you might use some business relief up to the million, but really we're doing a number of different things, and that really is kind of the most effective way of with dealing with this.
Thank you, Daniel.
Yeah,
and Kira,
I would
thank you
echo that.
very much. Sorry, Harriet, just thanking Kira for the question, which was greatly appreciated. It looks as though that's it for the questions. So I just wanted to thank everybody for their time today. We will send contact details around following the session. So if you need to speak with Harriet for some legal advice, or Daniel for some financial advice, or if you do have these challenges where an estate is cash or liquid, we'd certainly love to explore being able to assist with that. I think unless anybody has any other questions, then we will just thank you for your time and tell you to have a fantastic day. Thank you, Harriet. Thank you, Daniel.
Thank you.
Thanks, everyone.
Take care all.